Hey everyone, welcome back to Corporate Decoder, where we unpack the hidden stories within financial filings. And today we're diving deep into the latest annual report from Kinetik Holdings Incorporated. And let me tell you, their numbers paint a pretty interesting picture of growth challenges and some rather big strategic moves. You are not going to want to miss this. So stick around before we jump in if you're appry. C8 getting straight unvarnished insights from these corporate beasts. Hit that subscribe button so you don't miss our future deep dives. And hey, if you want to chat about these filings or just nerd out about corporate finance, join our Discord community linked in the description below. Alright, so Kinetik Holdings Inc. just released their annual report for the fiscal year ending the 31st of December 2025. And if there is one word to describe it, it is transformative. First off, their total operating revenues saw a significant jump up 19% to a cool $1.76 billion compared to the previous year. This is a big deal, and it is mostly driven by their product revenue, which climbed a whopping 23% to over $1.3 billion. This tells us they are selling more of the raw commodities like NGLs and condensate, and getting better prices for their natural gas residue too. On the service side, their revenue also grew by 9%, reaching $445.5 million. This includes fees for gathering, processing, and disposal services. Basically, they are charging more for moving and treating more gas and crude oil, especially with a notable increase in crude volumes by 21.3 million barrels per Dalton Y, or a massive 55%. But here is where things get interesting. While revenues are up, so are their costs. Operating expenses jumped by 38% to $271.4 million. A big chunk of that, nearly $30 million, comes from Durango's full year of operations. And another $23.7 million is from the Barilla Draw acquisition in January 2025. So they are spending more to handle all that extra volume, a pretty standard consensus. Sequence growth, but something to watch. Speaking of spending, depreciation and amortization shot up by 18% to $382.6 million. This sounds like dry accounting, but it means the value of their physical assets like pipelines and processing plants is going down on paper, mostly because of recent acquisitions and assets they've put into service. Now, for one of the biggest financial stories in this report, a gain on the sale of an equity method investment soaring by over 300% to $415.4 million. This is largely thanks to their Epic sale in the fourth quarter of 2025, where they cashed in big time, selling their stake in Epic for over $500 million up front. They also stand to gain another $96 million depending on future capital projects within Epic. That is a huge win and really highlights their strategic maneuvering in managing these large investments. Let's talk about how Kinetik is structured. They are primarily in two main business areas: midstream logistics and pipeline transportation. The midstream logistics segment is their powerhouse, covering gas gathering and processing, crude oil services, and water handling. They've got over 4,200 miles of pipeline and some serious processing capacity, over 2.4 billion cubic feet per Dalton Y in the Delaware Basin alone. That makes them one of the largest processors there. Their pipeline transportation segment involves significant stakes in other major pipelines like PHP and Breviloba. These are long-haul pipelines connecting the Permian Basin to the Gulf Coast and Mexico markets. These are crucial for getting their products to wider markets. Looking at recent developments, the Barilla Draw acquisition in January 2025 for $175.5 million in cash was a smart bolt-on move. This expanded their crude gathering services and added more natural gas pipelines to their network. And as we mentioned, the Epic sale in October 2025 was a major strategic play. They sold a significant chunk of their ownership in Epic, which really boosted their cash and likely reshaped their investment portfolio. Now let's look at adjusted EBITDA, a key metric for profitability. Adjusted EBITDA increased by a modest 2% to $987.7 million. This shows that despite the revenue growth and increased expenses, their core business operations are remaining quite stable and profitable, even with the strategic divestitures and acquisitions. Breaking it down, their midstream logistics segment saw a 3% increase in adjusted EBITDA to $635.8 million. Thanks to those higher revenues I mentioned earlier, but pipeline transportation saw a slight decrease of 2% to $370.1 million. This is largely due to them selling off stakes in some of those equity method investments. Like Epic and GCX, less ownership means less EBITDA from those sources, naturally. When it comes to cash, Kinetik is in a solid position as of the 31st of December 2025. They had total liquidity of over $1.2 billion. This includes a significant amount of available borrowing capacity on their credit facilities, which is great for flexibility and handling any unexpected needs. However, debt is a major factor. Their long-term debt net stands at a substantial $3.6 billion. As of the 31st of December 2025, 2025. They had $1.05 billion in senior notes due 2028 and $1 billion in notes due 2030, plus a hefty $1.15 billion from their new term loan and $453 million on their revolving credit facility. While they have good liquidity and their income is growing, we need to keep an eye on that debt load. Their investment in physical assets is massive. Property, plant and equipment net is valued at nearly $3.9 billion. They spent over $492 million on property, plant and equipment in 2025 alone, showing a strong commitment to expanding and maintaining their infrastructure. Their intangible assets net are valued at over $553 million, primarily consisting of customer contracts and right-of-way assets. This shows the value they place on their long-term relationships and the rights to operate their pipelines, which are key to their business. Now let's talk risks, because no corporate story is complete without them. Kinetik is heavily concentrated in the Permian Basin, a prime location, but also a vulnerability if that region faces disruption, whether from regulations, weather, or market downturns. They feel it disproportionately. They admit that acquisitions and divestitures are a big part of their strategy, and while they aim for benefits, they also face difficulties in integrating new businesses and could fail to achieve expected results. This is a classic risk of aggressive growth. They also heavily rely on third-party pipelines to get their product to market. If those pipelines experience issues, Kinetik's revenue and cash flow could suffer. This dependency is a tangible risk they are exposed to. And let's not forget the influence of major shareholders like Blackstone and I2 Capital. They own a majority of the voting shares, meaning they can strongly influence corporate actions. This is common in the industry, but it is always worth noting when large investors have such significant sway over a company's direction. Looking at the bottom line, net income, including non-controlling interests, more than doubled to $525.9 million in 2025. That is a fantastic improvement, and part of that gain comes from $415.4 million on the Epic sale. But even without that extraordinary gain, their operational performance looks strong. Their total segment adjusted EBITDA was nearly $988 million, showing resilient core operations. This is a crucial indicator that despite all the market fluctuations and strategic moves, their fundamental business is generating strong cash flow. They also highlight risks from trade policies and geopolitical uncertainty, which can impact costs and demand for their products. And if we're being honest, this is a significant unknown that no company can fully control. So what is the verdict on Kinetik Holdings Inc.? Well, they are a company in serious growth mode, aggressively expanding their midstream infrastructure and making shrewd strategic moves with their investments. Like the Epic sale, they've clearly benefited from strong demand in the Permian Basin, and their core operations are robust, showing healthy EBITDA growth year over year. The debt load is significant but manageable given their strong cash generation and access to credit lines. The major risks appear to be their concentration in the Permian Basin and their reliance on third-party infrastructure, as well as the present unknown of commodity price volatility and regulatory changes. However, their financial performance shows a company that is executing well on its strategy and is a major player in the midstream energy sector. That is it for our deep dive into Kinetik Holdings Inc. Latest annual report. What are your thoughts on their performance and their strategic direction? Let me know your opinions in the comments below. If you found this breakdown helpful, give this video a thumbs up and subscribe for more corporate dissections. And remember to join our Discord community, link down below, where we break down these filings together. Thanks for watching, and we will see you in the next episode of Corporate Decoder.